What's up, everybody? It's your boy Orlando, aka King Smitty. And I just want to thank everybody for rocking with me so far. If you can go ahead and hit that like and subscribe button, we're making our way up to 100 subscribers. I really appreciate all of y'all. And today we're going to be talking a little bit about rotation and a thing called tax harvesting. But you got to stay tuned for that one. So first, let's look at my portfolio compared to the S&P 500. You can see right here on this first image, I am up 80.05% year to date, whereas the S&P 500 is up roughly 15-16%. You can see I'm the blue line, and the S&P 500 is that doo-doo green looking line, right? So that's the first start us off right there. Second, my thing about this video, like I said, is rotation. I've been reviewing my portfolio, and there's a lot of those growth stocks that I didn't have stop losses on that's been getting hit really hard this year. And my thing is, it's time to rotate. The beautiful thing about the stock market is, if you lose money on a stock, you don't have to make that money back in that same stock. That's what a lot of people mess up on. They're like, "Oh, I lost a lot of money with this stock, so I'm gonna put more money into it and try to recover my losses." That's not how it works, and it doesn't always come back. Some stocks, when they drop, it doesn't come back. This isn't basketball. This isn't physics. What goes what goes up must come down. But at the same time, in the stock market, what goes down doesn't always come back up, right? So you don't have to make your money back in that same stock. So what I've been looking at is some of my plays. They've been beating earnings, but at the same time, if you look at their earnings, at one point it was expected to have 30 cents per share. Oh, but we beat it. We got 32 cents per share. The next quarter, we're supposed to beat earnings. We're supposed to make 35 cents per share. We hit 37 cents per share. Same stock now. Oh, we're supposed to beat earnings. We're predicted to hit 19 cents per share. We hit 20 cents per share. So, like, yeah, you're beating earnings, but you're predicting to go lower still. You know what I'm saying? So now that trend is reversing. And don't get me wrong, the whole market is kind of doing a little pullback or whatever. But at the same time, your earnings are going down lower, and you're projecting lower earnings and setting lower boundaries for yourself. And then the company is beating those lower boundaries and expecting to get praise for it. It's not going to happen. So that's why I say it's time to rotate. And first, before we look into everything, I have a picture of the S&P 500 right here. And you can see the highs of the S&P 500 is roughly, we'll say $458 at the top. Looking at a 6-month chart. And then it came back down and it almost hit a support line, which is at $432 roughly, $430 roughly. You can see it kind of barely missed it. It almost touched that here in August. It got down to like 435 maybe, 433, and then it bounced back up. And it's important that you know what the whole overall market doing, what the S&P 500, the Dow, the Nasdaq, because your stocks should almost emulate what the market is doing. If you see this chart right here, how it's going, it went down in May, it went up, kept going up pretty much, and then in August, late July, early August, then it started coming down, and that's got to bounce. If your chart is just going straight down and it's not mimicking the S&P 500 or the Dow or the Nasdaq, that might be a bad stock. Yeah, if it can't keep up with the market right now, it might be one of those stocks that you might need to rotate out of. Of course, I'm no financial advisor or whatever, but my thing is with this, when it hit that support level, it makes me wonder, is the correction over, or is this like a dead cat bounce? A dead cat bounce. I don't know if you ever seen a cat get hit by a car or something, but it falls and then it jumps up because it's in pain, and then it hits the ground again. So my thing is this that dead cat bounce where like the stocks dropped, get a quick little bounce, and then it continues to tank? Because if it continues to tank, I can see the S&P 500 easily going back to 405 in the short term. And then if it breaks the 405 level, I can see it going to at least $384 in the midterm. Well, still kind of short term, really. So let's look at these other plays. And one of the ones I'm looking into rotating in is Tesla, which in my main portfolio has been my biggest winner. In my other portfolio, Nvidia has been my biggest winner. So I'll look at the stocks in that portfolio, and whatever I see is like a loser, I would consider selling that and then putting those winnings into Nvidia. But in this one, it's Tesla, it's Google, it's Apple, right? So you can see right now the stock is currently at $239.19. And you can see this stock chart almost mimics the S&P 500, right? It goes up, it drops in May, and then it runs up all the way to end of July, August, and then it starts to come down. And then you can see here, it almost hit a support line at 209. We'll say 209, 210 is a support line, and it almost hit that. But it reversed right above that, and it kept going down. So if this falls, I can see this definitely coming back to 209. It is a nice level of support. You can see it touch at least 2 times in the past, and then it kind of bounced right above it recently. So I can see that as a good little support line. So if it comes down, I'd hope it bounce off of there. You can see the blue circle I have right there. It's a thing I see in a lot of my videos. All gaps fill. So, and if you look back in late or early May, you can see there was a gap. I didn't circle it, but you can see that filled in June. So they got this little gap right here, and like it's in the process of trying to fill it now. So we'll see what it does with that. If it can break above $247, which is kind of like the lower bottom of that gap, and you can see as well in July, it kind of touched at that support line again, which is now resistance. If it could break through that, I could easily see this stock going back up to the 270s, 266, 267 range. And if it break that, then we can hit the 280 range, 285. So with Tesla, I'm looking to buy as many shares as I can because they're still haven't released the Cybertruck, and once that comes out, and they're lowering their prices, which makes it more affordable for more people to buy. And then they have their factories in other countries that are producing at a nice little rate as well. And then we haven't even touched like the Indian market, the market over there in India. So when Tesla gets over there, that's like a whole nother economy that's put money into it. So I'm just trying to get as many shares as I can right now. I know Elon said he's trying to buy a lot of the Nvidia shares. Nvidia stock, the chips, which is good for me because it's like one of my companies put money into my other company, which is my biggest winner. So Nvidia's chips is, they say it's one of the stocks that's kind of driving the market right now. It's holding the market up. And I could kind of see that. It has been a big runner. Any other things we've seen? So, yeah. Looking at my stocks, the companies that aren't performing like they once were, unless I have like strong conviction for that stock and like their forward guidance, I have to cut it. Like, don't get emotionally attached to these stocks. because these stocks are not emotionally attached to you. Putting your emotions in trading and investing, which I have been guilty for in the past, is going to lose you a lot of money. Rewind that. Put that in your rule book. Get you a list of rules and stick to them. That's how you're going to make money. I'm looking at the wrong camera. I'm sorry. I have the camera on my computer recording me today, but I'm used to my actual camera recording me. But I'm looking at this camera and saying, get you some rules, stick to your rules. If you trade with your emotions, you're going to lose a lot of money. A lot of money. And I can guarantee you that. So take the emotion out of it. Take the emotion out of it. Look at these. Look what's going on with the fundamentals and the technical analysis of the chart. And get to it. Right? But like I said, I'm selling a lot of these things for tax purposes as well. A thing called tax harvesting, which a lot of people don't really understand. But with tax harvesting, for example, I've made a lot of money off of Nvidia and SoFi. So when my taxes come, they're gonna be like, oh, you made a lot of money in stocks this year, right? And I would have to pay taxes on those gains. So what I would do is those stocks that I no longer have that strong conviction for, then their guidance has changed and their performance has changed, and I've been taking a loss on those, I would sell those to kind of try to counterbalance my capital gains. So say for instance I made $10,000 on Nvidia and SoFi and Tesla. Well, Digital Turbine and Bionanogenomics and another stock, I might have lost $8,000 for example. So now I could sell that, instead of on my taxes it's showing me making $10,000, it shows that I only made $2,000. So that's gonna reduce my tax bill. Or if you lose enough, which is not the goal. For example, it's not the goal to lose the money, but if you lose enough, you'll probably eliminate your tax bill. And a beautiful thing about it is, say for instance you are highly invested into this stock, your emotions are attached, and you're highly convicted to it, but you've lost a lot of money. You can sell that stock, wait 30 days so that way you can still claim it as a loss on your taxes, and then you can buy that stock again, right? Because if you buy it within 30 days, it's a wash rule. You get hit with that wash rule, which means there's no tax benefit. You can't claim that loss on your taxes. You have to wait 30 days after you sell a stock that you have a loss in before you can buy it back. So let's say for instance you put $10,000 in there, you lost $8,000, but you had 500 shares and the stock's been dropping. You sell that, take your $2,000 out, wait like 31, 32 days. At that point, if the stock is still doing bad, that stock probably continued to drop. And then you take that same $2,000 that you already had in that stock, put it back into that stock, and now instead of having 500 shares, I said, now you might have 520 shares with that same $2,000. Now it's not guaranteed that the stock is going to go up, but now you have more shares, and you have you did a little bit of tax harvesting. A lot of people like to wait for the end of the year to do their tax harvesting and to readjust their portfolio, but you could really do it at any point in time. I'm probably gonna do it like at least twice a year. I usually do wait till December to do this, but it's a good time now for me. I would like to put my money into the plays that are really making waves for me. As you can see, I'm up 80% year to date, but I'm sure if I sold a lot of those losers earlier on and put that money into my bigger plays, I'll probably be making a lot more than 80% year to date. Um, but yeah, so that's what I'm doing. Selling certain stocks, rotating into a little bit better plays with better forward guidance that I do have a strong belief is gonna make some waves in the future. But let me know in the comments, what's your biggest winners in your portfolio, and as well, what stocks are your biggest losers and that you think that you should possibly let go. And maybe you can buy it again. Maybe you just rotate that money. But let me know in the comments. Appreciate y'all for rocking with me.